Inflation in the United States is back. Inflation in January has risen more than expected, and the annual rate goes back above 6%, which shows that the narrative of combating inflation, of coming down very aggressively, is not happening. And the reality is that central banks remain hugely accommodative, but not just monetary policy. One of the problems why inflation remains so stubbornly high is that, on the one hand, governments are unwilling to reduce spending. On the other hand, central banks remain hugely accommodative and interest rates remain below the curve. And furthermore, what I think is also a very important inflationary impact is the rise of protectionism and the rise of interventionism. Governments are imposing more and more barriers to trade, more and more barriers to free commerce, and that is leading to a much higher level of inflation than what we would have even in an environment in which commodities have U-turned so quickly. The latest IMF estimates and the latest consensus estimates are showing that there may be a slightly higher level of growth for the United States in 2023, and that recession is unlikely. However, in this graph by Bloomberg Economics, what it shows is that the recession models and the probability of recession is actually much higher than what consensus and investment banks are estimating. And I think that's important to understand that the longer that recession is avoided via massive government spending, higher debt, and lower imports, there is obviously going to be a more significant backlash afterwards. So sometimes when we read that recession has been avoided because the government increased significantly its expenditure with higher debt and because there were lower imports, that may help GDP, gross domestic product, but not necessarily make anything any better, particularly because the longer that way of disguising slowdowns remains, the backlash will be higher. We said a few weeks ago that the weakness of the US dollar could be short-lived, and we have witnessed in the last month how the dollar has strengthened relative to the euro in particular, but also against most of the traded currencies, the currencies with which the US dollar trades. This is important for a very simple reason. When we look at the next years, in reality, demand for US dollars is rising. And that comes mostly because the trade and fiscal imbalances of most developed but also emerging economies are very high, and the level of indebtedness in US dollars is likely to increase as interest rates rise, but fiscal imbalances are not reduced. So more demand for US dollars globally, and certainly the comparison of monetary policy between the Federal Reserve and the European Central Bank or the Central Bank of Japan also shows that this is a world not in which a race to see who wins, but a race to see who loses. And the Federal Reserve, having the world reserve currency, can disguise some of its mistakes, while the mistakes in monetary policy of other central banks are larger. Modern monetary theory has been destroyed by 2022. It showed that even countries with a prolonged and long history of monetary sovereignty like Japan or the UK could see their currencies collapse due to completely misguided fiscal policies. The UK had a huge problem because of a budget that increased massively spending and cut taxes, while Japan saw that the central bank bank had to intervene at least 4 times in order to contain the debacle of the yen, simply because of the Fed rate hikes. Fed rate hikes showed that MMT, modern monetary theory, is a complete lunacy. It's complete science fiction. A country is not monetary sovereign because the government decides so. And a country and a government cannot spend what it wants anytime it wants and increase its debt without any problem. It is obviously a complete idiocy, and the reality that we're seeing, not now, but in the vast majority of economies, in all of the economies, is that there is no way in which a government can increase its debt and increase its imbalances without destroying the purchasing power of the currency, without destroying real savings and real wages. The Chinese economy is going to grow in 2023 much more than what was initially expected. It was around 3 to 4%, what most of the analysts had in their numbers for 2023, and is probably going to get closer to 5% in an environment in which the Central Bank of China needs to continue to be prudent because inflation is high in China for Chinese usual figures, obviously. No, it's around 4%, which, if we calculate it in the similar way to the rest of developed economies, it would be like what we have in around 6.5%, 7%. However, we need to be aware of the housing crisis in China, because the government is doing all it can to try to avoid a much larger impact on the rest of the economy. The government knows that the real estate slump is unavoidable. However, it needs to try to avoid it having a domino effect on the rest of the economy. And those measures that have been implemented are targeted at precisely that, at avoiding a credit crunch for the rest of the economy, and at the same time trying to avoid as well a big impact on employment from the burst of a real estate bubble, which inevitably has an impact on growth, has an impact on imports of commodities, and certainly an impact on jobs. So, Chinese economy getting better, but the slowdown of the real estate market is very evident and continues to have a significant impact on some of the gross capital formation figures. There is a big discrepancy between the European economy, the macro environment, and the earnings revisions, and the reality that is shown within the equity markets. Equity markets, the MSCI Europe Index, has been rising consistently despite negative revisions of earnings estimates, despite a much weaker earnings season than what one would have expected of a rising and multiple expanding index, and third, of a revision in macro estimates that basically just move the Eurozone from recession to stagnation, but nothing more. So the biggest problem that we find in the European markets is the elevated inflation of multiples and the big problem of expectations that are certainly very difficult to be met. The world of cryptocurrencies and the world of Bitcoin suffered a massive blow in 2022 due to the rate hikes and the liquidity crunch created by central banks. This basically showed the Achilles heel of many of the crypto assets that we knew of. That liquidity was provided by the US dollar, and therefore many of these crypto assets were unable to continue to rise in an environment enforcement of restrictive monetary policy. This year, things have turned quite different, and what we're starting to see is a more interesting difference between those crypto assets that are starting to show their relevance and others that remain simply huge beta plays. I think it's important to understand that for cryptocurrencies to become real currencies, they need to be 1, reserve of value, 2, units of measure, and 3, generalized means of payment. Some of them, like Bitcoin, are achieving that slowly, gradually, and they're certainly in a much stronger position right now than they were 5-10 years ago. However, we must pay attention to the liquidity factor, because if cryptocurrencies don't find a way to have liquidity on their own in a world in which central banks continue to erode the purchasing power of the currency, then they may not become the alternative that they should, or at least could, in the at least paper idea of what they were going to be in 2008. Central bank asset inflation continues. We think that what is happening right now is incredible. We're seeing a market that is rising despite central bank tightening. But the problem is that central banks aren't tightening. The balance sheet of the main central banks has not come down, certainly not in any shape or form. This is something that we could call tightening. And the rate hike path that has been set remains hugely accommodative. That is why global demand for credit and global supply of credit remain very, very high, and that is why the market has found out that what central banks are doing is not tightening, but keeping a very loose monetary policy. That is why multiple expansion is back with a vengeance, but we need to be aware that at the same time, inflation is not controlled. And the January figures that we're seeing are proving that the reality of inflation is much more stubborn, much more persistent than what many hoped for.